Okay, welcome back to Infant Investors, the home for all new and non-investors. I'm Curtis, and today we're going to talk about the top 10 lessons that I've learned investing this year. Listen, first of all, before I get into this video, I want to give a big shout out to Phil within the free trade community. He created this post, "What did you learn about investing this year?" And here he talks about all of the lessons he learned, and he also gave me and the channel a shout out, and I did contribute with the lessons that I've learned, and so have other people contributed with the lessons that they've learned. And this did inspire me to create this video. So in today's video, I'm going to talk about the top 10 lessons that I've learned investing this year. Some of the principles we've talked about in many videos, and there might be some new ones as well for you. So if you want to know what they are, please like, please comment, please subscribe, help the channel get to 3,000 subscribers, and we can get the world of investing out to more people in a clear, simple and transparent manner. But first, let's get into this. The top 10 investing lessons that I've learned this year. Number 10, percentages matter, not money. Too much do I see conversations, not necessarily directly at me, but within other people, talking about you need to invest this amount of money. You should be putting this amount of money. Don't invest unless you've got 10 grand. Don't invest unless you've got 20 grand. All of these make-believe artificial numbers. Now let me be crystal clear. Had this been 15, 10 years ago, maybe even 5 years ago, where all of these new emerging commission-free brokers weren't around, then yes, there would be at least a minimum requirement you should invest, because the amount you will be charged in terms of commission will actually erode your returns and your margin should you not invest a certain amount. So people would say actually you should be investing at least £500 or £1,000, because if you're going to get charged, say, I don't know, £7, etc., then you need to get a certain amount of return in order to actually break even. That did apply back in the day. Now with the likes of free trade, Robinhood, Trading 212 and many others, you don't need to have a certain amount. This has actually broken the barriers and democratized investing for all. So anyone that's investing with £100 to their name from an investment standpoint, £50 to their name, my recommendation is get into the market, worry about the percentages. If you invest in one stock and you get a 50% return on £100, and I invest into a different stock and I get a 2% return on £1,000, you have made a better stock pick than I have, and you should be proud about that. You should learn about what you're doing well, and obviously try and rinse and repeat whatever it is you're doing. So yeah, don't worry about how much money you're starting with. Just get into the market and focus on the percentages. That is what matters. Number 9, institutions move the market. In probably about 70 videos, I talk about how institutions move the market. I typically like to invest into companies that have a high institutional holding, because from a smart money standpoint, institutions put a lot of investment in analysis and analysts that actually can decide and deduce whether or not a stock is actually a viable stock to hold. Not only that, the big orders that institutions put into each and every stock actually then moves the stock into each direction. Now, there is momentum that you get from retail investors, of course, but typically the big swings that you might see in the market in any bullish or bearish direction is typically due to institutions. So trying to understand and see where institutions are investing and what they're doing could give you a little bit of a foresight and a little bit of a benefit in terms of investing into the market. So yeah, always remember that institutions move the market, and it's good to understand what they're doing to get a general idea of market direction. Number 8, have 3 reasons to invest. I always talk about having 3 reasons to invest into any stock. For me personally, it's not good enough just to say, you know what, I'm going to invest into this stock because I like their product. That's just, for me, not a good enough reason to part with your money. You know, I like a lot of products out there. Doesn't mean that I would invest. I book my holidays with booking.com all of the time. Doesn't mean that I'm going to invest my hard-earned cash into booking.com from an investment standpoint. So I think it's always important to have 3 reasons to invest. It could be that, you know what, the company's undervalued, their earnings per share has risen month on month or quarter on quarter, and they've just introduced a brand new product line which I think is going to return X amount. Or it could be, if you're a dividend investor, their dividend yield is good, they've got a good payout ratio and good dividend cover. Or it could be, you know, the company's got low debt, they're in a growing market, and their past performance last year was better than the industry average. Whatever it might be, having three sensible reasons to invest into the company, for me, is going to give you greater confidence that you're actually making a better stock pick. And if it does go wrong, then obviously you can still learn from it, and it might still go wrong. But I think the more reasons you've got, better. If you can have 8 reasons, 9 reasons, 10 reasons, then of course, the more reasons would always be the better. But I would say have at least 3 reasons to invest into any stock. Now, some of the things we just talked about, and which leads into number 7, is know the fundamentals. For me, understanding the fundamentals is extremely important. Understanding how undervalued a company is, understanding all of the ratios from PE ratio, PEG ratio, price to book ratio, price to sales ratio, understanding the past performance, understanding their dividends and all of the dividend metrics, understanding everything about the balance sheet from debt to its assets to its cash flow, etc. Understanding their customer numbers, or if it's a company that requires orders, their order numbers, or if it's a company that produces their production numbers, whatever it is. Understanding the fundamentals of a company and knowing what direction the fundamentals is going in is extremely important, and that's going to help you decide that actually you're making a very sound investment. And when there's a lot of economic factors that's going to sway the performance of a company, you can feel confident in the decision that you're making. This goes into number 6. Watch the economy. Unfortunately, it is not enough to just know the fundamentals of a company. Too many times have I invested in companies which have had great fundamental performance and great fundamentals, a great balance sheet, but the stock keeps on going down. And the reason why is due to the economy and the macroeconomic landscape. In a previous video, I talked to you about pestle analysis. It's a great analysis technique to help you understand the landscape of a company. It is no longer good enough to just understand the company fundamentals itself. You need to also understand the landscape in which the company sits within. Pestle analysis talks about the political landscape, the economic landscape, the social landscape, the technological landscape, the legal landscape, the environmental landscape. Think about all of the factors that we've experienced this year. Look at, as an example, the election results. That's a political landscape, and that has had an impact on stocks. Look at the economic landscape when we talk about recessions and yield curves. That has had an impact of stocks. Look at the social landscape when any social impact that's happened in society, that will have an impact on stocks. Look at the technological landscape. Look at the reason what's happening with AI or any other emerging trends, that's going to have an impact on stocks. Look at the legal landscape. Look at what happened with banking stocks and PPI, that had a massive impact on a lot of my stocks. Look at the environmental landscape. What is the reason why some of the mining stocks aren't doing so well, and why some of the renewable energy stocks are doing well because of environmental impacts. It's really important to understand the macroeconomic landscape, and it goes further and beyond that. Understanding the macroeconomic landscape is understanding inflation, understanding what's going on with the pound, understanding trade wars, understanding anything that could potentially have an impact on your stock. So watch the economy, stay abreast of what's going on, and that is going to help you have a better performance going forward. Next, number 5 is to always have a strategy. I always say this: have a strategy. What is it that you are trying to achieve? When you're talking about your strategy, you need to think about what is your horizon, what is your criteria, how much money are you going to allocate to certain types of stocks, how frequent are you going to invest, are you going to dollar cost average, or are you going to put a lump sum in, are you going to diversify, how are you going to diversify, is it by asset class, by region, are you going to diversify by market cap? There's so many different ways to kind of think about your strategy and what you're going to do. You guys saw in my 2020 vision my strategy, and my strategy is a direct response to the performance that I've had this year. So having a strategy, whatever your strategy is very important. I would encourage you to write it down, get it down on paper, and that way, if you do well, then cool, do more of it. If you don't do so well, then obviously you can learn from it and hopefully do better next time. The next one, number 4, is when there's blood on the streets, you bride. This is the contrarian investing view. This is the quote from Baron Rothschild. I talked about this in a previous video. When stocks drop, you buy more. This is often taught and, very, very, very rarely followed. This is a seldom followed principle, but I've seen it on multiple occasions with my own portfolio where even I've been like, I'm not sure if I'm going to buy. And actually, the stock tends to rise again. And actually, it's just an opportunity to buy more. Also, there is the view that if you follow the market, the sentiment in the market, then generally you might be making a bad decision, because generally all retail investors aren't going to be making sound fundamental based decisions. There's going to be a lot of hype in the market, and if you're just doing what everyone else is doing, it's quite probable that, not in all scenarios but in some scenarios, that you're actually going to make a bad investment choice. So when things aren't going so well, that's actually sometimes the best time to get into the market. And that goes into number 3. Don't get all emotional. Listen, don't panic. It is extremely hard to see losses. I understand how hard it is to see losses. And this is the reason why I'm so transparent with my losses. Why have I produced videos where I talk about me losing $6,000 day trading, or produce other portfolio updates where I talk about, this week I was down £700, or this week I was down £1,000. I want to show you that losses are normal, that all of us experience losses. Don't let anyone make you think that, they're superior to the market and they've never lost any money. Losses will happen, but overall, the market direction is usually up. And overall, if you stick with your game plan, you will make a lot more than you would ever make anywhere else, than obviously being in the market. So don't panic when your stocks are falling. Try and look back at the fundamentals. Does everything stay the same? And fundamentals do change. Has something recently happened which has caused everything to go tits up? If that's the case, then obviously you need to make a decision on whether you still want to hold that stock or not. However, if the fundamentals are still strong, but for whatever reason there's maybe some economic market pressures that's pushing the stock down, then actually don't panic. And actually this goes back into, number 4, buy more potentially. Or, you don't have to buy more, maybe you just want to hold, but it doesn't mean that you should panic sell. And so I think it's really, really important to try as much as possible to remove all emotions when you are investing into the stock market. This also goes into the other direction, the fear of missing out emotion, and people that see things rising and then just want to buy. I am also very, very guilty of this. Even my recent video about Tesla, slightly emotional, because when Tesla's rising, I'm thinking, you know what, I had the opportunity to go into it. I didn't pull the trigger, and now I'm missing out. I made a video on Snapchat many, many, many moons ago where I was about to pull the trigger on Snapchat. I didn't do so, and now I lost 45% not investing into Snapchat, and so I got into it really late. You can have fear of missing out, or you can panic sell, but trying to reduce or remove any emotion is critically important when you're investing in the market. Number 2, know thyself. Know who you are. You need to know who you are at the end of the day. Listen, you can listen to others, but I would say do not blindly follow what anybody else does, because nobody knows you better than yourself. Even me, I really appreciate all of you guys watching and listening to everything I say on this channel, but I would absolutely hate it if I found out that any one of you was blindly copying every single thing that I do, because we're all different. I might have a higher risk tolerance than you are. So just because I invest into something, it doesn't mean that you should invest into something. Even if people tell you do this and do that, take the information on board, analyze it, maybe do some research on the information that's been presented to you, and then make a decision that actually best suits you. Try not to just copy what any other YouTuber or friends and family or whoever does within the market. At the end of the day, it's your money. You're the person that worked hard for it, and you're the person that's going to be accountable for, losing that money or obviously making that money. So know who you are, and obviously make sure that you are, happy with what investments you are basically doing. And number 1, the most important thing that I've learned this year is to set your goals and to make sure you try to achieve them. But if you don't, learn what you did wrong and obviously adjust and pivot for next time. I set a goal of having a 10% return this year. I landed at 6.31%. That directly impacted my 2020 vision, because I felt that, for me as a person who currently works in the tech sector, and I invested in pretty much no tech stocks, even though I understand them to a much higher degree than, say, house building, I never used that to my advantage. And so for me, I'm going to put more money into into higher growth tech stocks that where I understand the business model a lot more. And that for me is just about learning where you went wrong and applying it going forward. So if I hadn't set a goal, I might have ended up on 6.31%, but I would have felt that actually that could have been good and then carried on the same mistake for next year. The only reason why I'm changing is because I actually set a more of aggressive goal. Now you might set a goal and actually you realize it's too aggressive, but it doesn't matter. I think it's very, very important to set your goals. It could be goals about how much you want to invest. It could be goals about what type of return you're looking to get. It could be goals about what type of dividend yield you're looking to reach. Whatever your goals are, I think it's absolutely important that you set goals. And this is the reason why it's my number one lesson that I've learned this year. Why do you think in every single investment video I talk about the goal of subscriber numbers that I want to get? I'm just a very goal oriented person in general. I've been like that all my life, and I think it's helped me get to where I've got to today. So, set goals, try and achieve those goals, try and tick those goals off the list, and then obviously keep on rinsing and repeating that, and hopefully you can improve going forward. Listen, I hope you found this video useful. If you did, please like, please comment, please subscribe, and I will catch you next time with another investment video. Peace.